What's up, everybody? Jay Martin here, investor and CEO of Cambridge House, and my guest today is Nicole Adshead-Bell, the director of Cupal Advisory Corp. Now, Nikki is one of the personalities in the junior mining sector that you need to know about. Now, this isn't just coming from me. The way this interview came together is because one of my long-term mentors in the junior mining sector is named Rick Rule. Now, you might be familiar with Rick if you've spent a day looking at the junior mining sector. He's one of the best known faces and names in that industry, and just a fantastic human being. But Rick was the face of Sprott US management, Sprott Asset Management for a very long time. He has since retired at the top of his game after 40 plus years being at the top of the game, which is a very hard thing to do in one of the most volatile industries on the planet. But every time I sit down with Rick, I ask him, who are the personalities that you're paying the most attention to? And the last time we sat down was maybe 6 months ago, and he said, Nicole Adshead-Bell. You have to get Nicole Adshead-Bell on your show. And so he introduced us, and here we are, and it did not disappoint. I learned a ton. I hope you enjoyed this as much as I did. We covered the whole gamut of the junior mining sector, not just from vetting entrepreneurs and management in the space, which is like my #1 criteria. As I say all the time, I'm people over everything every single time in this sector. And so we got into how Nikki values management. What do you look for to determine what's a good manager versus a bad manager? Who do they surround themselves with? All of this stuff. We got into buy strategies. More importantly, we got into selling strategies, the harder part of the trade, the part of the trade that I lose way more sleep over. How do you get out of a position, right? Whether you're up or down, and make those very difficult and complex decisions. We got into just basic decision-making psychology, right? And what often leads investors astray in this market. So if you have any interest in investing in the precious metal sector, the base metal sector, the resource sector in general, this piece of content's for you. I really hope you enjoyed it as much as I did. This is Nicole Adshead-Bell. 3 things before we begin this interview. #1, this YouTube channel now generates a significant amount of ad revenue, and I didn't see that coming, but it does, which is great. So what I've decided to do is donate that cash to an organization that is super close to my heart. They're called Zero Ceiling. Zero Ceiling's mission is to end youth homelessness. The way they do this is by giving at-risk urban youth the opportunity to relocate to beautiful wilderness areas and then surround them with supportive housing, career training, and just generally good influences. I love what they do. Check them out if you're interested. #2, if you prefer to listen to my content as opposed to watch it, you can find me wherever you listen to your podcast. Just search for The Jay Martin Show. And #3, I publish a weekly newsletter. The link to subscribe is pinned beneath this video. I publish every Friday and just ramble on whatever I'm watching in the market, where I'm allocating capital, or just give my opinion on things that I think that matter. And I love writing it. It's probably the favorite thing that I do, is authoring that newsletter. So check it out. There's a pinned comment right beneath this video. All right, here is Nicole Adshead-Bell. Enjoy.
This is Jay Martin.
What's up, guys? Jay Martin here, investor and CEO of Cambridge House, and I'm joined right now by Nicole Adshead-Bell, the director of Cupal Advisory Corp. Nikki, how you doing?
I'm doing well, Jay. How are you?
I'm really good, really good. I'm excited to jump into like a whole web of topics with you today. Maybe I'll start with why we're speaking, because this is notable. A personality in the resource sector who you and I are both super familiar with. I'm talking about the former face of Sprott Asset Management for like a decade or a decade and a half, and someone who's always been super generous with their time with me, which I've always really appreciated, because a true legend in the investment game is Rick Rule. And I was chatting with Rick, maybe 2 months ago, and I said to him, you know, Rick, who are the up and coming personalities in the space that I have to have on the show? Who are you paying a lot of attention to right now? And right away, he said, Nicole Adshead-Bell. You have to talk to Nicole Adshead-Bell. So that's how we were introduced. I think Rick probably introduced us. And here we are. So for my audience, if they're not familiar with you, Nikki, and what you do, who are you and how do you spend your time?
I'll try not to talk about myself too much. I am a geologist originally. So probably by my accent, you can tell, born and educated in Australia, moved across to Canada around 21 years ago and worked as a geo, did a PhD in geology, and then turned to the dark side, as everybody calls it, turned to the financial side of the business back in really what was the beginning of the bull market in all commodities, although it didn't seem that at the time. This was back in 2003 when my first job on the dark side was working for a precious metals fund. And so I think that was my expose and exposure to the capital market side of the business, with obviously a big focus in Canada. And so I then spent the next 17 years or so working on the buy side for a precious metals fund, working as a sell-side analyst covering uranium when nobody could spell uranium up towards the peak in early 2017. It was crazy times between 2005 and 2007 where the bull market in all commodities really took off. And that was really the China investment thesis. And then I turned to the even darker side, became an investment banker at Hayward for 4 years, and then exited that, decided I was too honest to be an investment banker for the rest of my life.
We're going to dive into that.
And personality-wise and culturally, I'm perhaps a little bit too blunt. And then went back to the buy side to work back for Sun Valley Gold, precious metals fund, SEC registered, and a really big focus. And this was such a privilege, actually. A lot of tire kicking, physical tire kicking, and so visiting assets, building very detailed financial models, meeting with management teams. And so you have this incredible entree into the sector, and because you represent capital, and as we know, everybody loves someone who represents capital. And I think that you have to understand when you're on the buy side, it's not about you. So don't take the fake love for what it's worth. It's about the capital that you represent. So spent the next 4 years building out the team in Sun Valley, and then resigned at the end, mid-2015, and really went off on my own. So Cupal is an very active investor in the sector, and I also do advisory work, I suppose you would call it, and that's just normally funds who know me very well, whether they be traditional equity funds or debt funds that reach out and maybe want some help with due diligence, and then companies that might want an opinion on an asset or help with maybe understanding a transaction or how the market may respond. So I do a bit of that as well, and then I sit on a couple of boards. So and then I suppose lately I've had the privilege, I suppose, of also being able to have discussions with very well-known people in the sector, such as yourself. And so that's been kind of a great way to just make sure that you're in the flow in terms of news. What are people thinking? Everybody has a different perspective, and that's all very, very valuable in what, at the end of the day, is a very small world. Mining, as we know, 1 degree of separation.
1 degree of separation. Yeah, no kidding. It certainly is. And so when you describe Cupal as an investor in the sector, just for context, Nikki's talking about the commodity sector. And, obviously most people that watch my show know that's the sector that I'm heavily exposed to, and for reasons that I explain regularly. Not the only sector that I look at though, but one that I'm maybe more bullish on than the other industries that I look at. Like, I'm very invested in the health science sector. I love it out of a personal passion, right? But it's very hard to find, I think, smart opportunities. Nutraceuticals, food technology. But today we're going to talk about commodities. And so here's something I want to pull on this thread. Your background is a geologist, so you were on the company builder side, right? You're helping companies find the ingredients that are required to build the technology that you and I live our lives on, right? The reason we can have this conversation remotely is because of the technology that these resources build. Okay, so I need to pull on two threads here. First of all, let's just get into the dark side a little bit. And for anyone who's not familiar, why might you draw that parallel and call switching from the company builder side as a geologist over to the capital market side, meaning you're now raising money, right? Why would you call that the dark side? Why would you make a comment that said, I'm too honest to be an investment banker? I'd love some color there, and don't be shy. And then clarity for anyone who's not familiar on the difference between what sell side and buy side means.
Sure. So I think as a purity, someone who's attracted to the technical side of the business, you aren't becoming a geologist or a mining engineer with making money as your core focus. And so I think the dark side maybe is if you're doing economics or you're doing business at university, there's a big driver for that is the economics that may come out of it. So there's in some ways maybe a naivety and a purity on the technical side. And geologists, unfortunately, and it's part and parcel of what the kind of person that's attracted to geology tend to be, we're very, very poor negotiators. We're the lowest paid of the technical group. If you look at engineers versus met guys, we generally are very poor at understanding that, to your point, we are the foundation of everything in mining. Without a geologist, you can't change the rocks, essentially. So we're the R&D part of the business, and we're not valued that way. And part of that is we don't value ourselves enough. And so when I did geology, did undergrad, and during my PhD, I came out at a really terrible time in the sector. It was finished in January 2000 and basically and that was when everybody was suicidal, mining was dead, commodity prices were never going to retrace backwards. This classic cyclical part of our business that we know is always going to be there. And I started thinking about alternative careers, actually, because I didn't want to be an academic. I felt like my ability to have a viable long-term career in mining was somewhat limited. There were basically zero jobs. And so when we first came to Canada, I was working for Frontier for Mark O'Day's group. And that was a great experience, because when you work for a junior, you're doing a bit of everything. So we were doing technical work. Myself, and we were in partnership with Altius at the time. So Chad Wells, who's now VP Corp Dev for Altius, we were doing target generation, what became Michelin, which became the uranium spin out. We're doing full work in the Northwest Territories, and also got a very good, at the beginning of the understanding of what this thing called capital markets is. And as a junior, obviously, it's always about where does your next dollar come from? How do you generate enthusiasm for your company, particularly at a time when nobody wanted to hear about mining? And so I think I didn't really have an understanding of the business side of the business. And I'd say it's a lack of our degrees that geologists don't understand that there is this circling pool of capital that you need to access, and that you need to be able to message what it is you have to make that business desirable to those capital suppliers. And then through kind of a fortuitous set of circumstances, I had the luxury of having my first job on the financial side of the business be on the buy side. In some ways, the buy side is a little bit more pure, because at the end of the day, you're making investment decisions that you have to live with. And so there's an honesty maybe on the buy side and a frankness that you can have, because you have to live with your decisions. And as an investment banker, you don't. An investment banker, it's fee driven. There's a one point in time event, whether that's an equity financing or an M&A event. The banker gets paid and moves on. So your compensation is not geared to the success of your decision, whereas on the buy side, working for a fund as an active investor, your compensation is directly linked to those investment decisions that you make and that occur over a long time. So there just is a fundamental mismatch in terms of how bankers view transactions versus how investors view transactions. And when I talk about the sell side is they connect the companies. If you want to think about it simplistically, the sell side is the intermediary between the investors. So investors like you and me, or investors that are very large institutions, and the companies. They're the intermediary. They're writing the research to pitch the companies. They're trading the shares, and the investment bankers are obviously there to help with equity financings and on the M&A side, simplistically speaking. So buy side are retail investors. Buy side is anybody who's actually buying equities. So that's high net worth, low net worth, retail, and it's institutional investors. And the sell side are kind of the suppliers. At the end of the day, they're the groups that supply that capital.
Yes. And all are important parts of the ecosystem.
That's right.
Yeah, and it's simple the way you described it. The difference between a buy side and a sell side participant would be one has skin in the game, right? One is buying the shares of a company and they're reliant on the performance of those shares to be rewarded. Whereas on the sell side, you are selling the shares as a broker between a company and an investor, and you're not tied to the performance of that company. That's where things can get dark, as you said. If you're strictly fee-based, brokering financings on behalf of other people to other people, you're maybe more likely to lower your quality control as long as you're able to get the product at the door, because a fee is a fee regardless of the quality of the shares you are brokering.
That was a very elegant way of putting it, and I'll steal your description from now on. Yes, you're right. So the banking industry in and of itself it's not an evil or it's not bad. It's just that you have to understand incentives, and their incentives are very, very different to those incentives of an investor. And I think sometimes, particularly in the junior sector, you might have management teams that have a lot of naivety with how this thing called capital markets works. And when you are wined and dined by an investment banker and they're selling you the pitch, it's at the end of the day, you have to understand what's driving them economically, and what's driving them may not be in your best interest. So it's having an understanding and maybe an education about how that side works versus the corporate side and the investing side.
Yeah, I love how you tied it back to incentives because it pulls directly on the conversation we were having before I hit record on so many issues in our world today that are driven by incentives that make us sort of draw lines in the sand between good and evil. And really, we're just operating in a system that we created, which I support as a capitalist, incentive-based structures. That's how you reward people. But so anyways, let's segue from here into navigating management teams, because you made an important point there about sometimes management. So we're talking about the management of a company doesn't understand the motivations of the brokers that would raise them the capital, right? And they can get themselves in trouble as a consequence. And so when we talk about the resource sector, the commodity sector, what I hammer to my audience all day long is it's people over everything every single time. And, I think that that's the way I invest in this industry, because you got to play the hand that you're dealt, right? And I talk to people for a living, right? I run an investment conference company. So I have a lot of high touch experiences with the people that drive the business forward, whether they're the financiers, the company builders, whatever. That's the hand I play there for. So that's the hand I can talk about. I'm not a geologist, right? So I can't compete on that front with the analysis of the geology and the rocks. I can't look at the management. So what can you look for though, Nikki? I mean, I know I've heard you speak about this. You just did the trap that management can fall into when they don't understand the capital markets, which is the mechanism for them to finance their business. What occurs here and what can you look out for?
Yeah, I mean, I think you and I are talking from the same playbook here. The way that I look at the business is exactly the same as you. People, at the end of the day, they're the most important criteria. And you can have a great management team extract a huge amount of value from a mediocre project, and you can have a poor management team destroy value in a good project. So it really does. Sometimes some people say the project's the most important. It isn't. Absolutely not, in my opinion. If you have a management team that understands the business, and it's not just our business is, you have so many companies that are competing for capital, literally thousands of junior companies around the world, all looking for people like you and me, and ideally thousands of them wanting to buy their shares. So how do you stand out? So you kind of have to understand how to message your story. Selling is a really important part of the business. So you have to be able to message it well. So promotion it can be considered a dirty word, but it isn't. It's really important. And it's something, again, generally, if small companies are run by geologists, and geologists may, particularly if they've come only from the technical side, may not understand that your job at the end of the day, you have to sell your story. So that's really important. You need to have a business plan that makes sense. I mean, it's no point a $10 million junior, for example, having a $1 billion build that they need to do that they think that they're somehow going to magically finance. You need to understand when to raise money. You need to understand how much to raise money. You need to understand the impact of dilution. You need to understand all the different financing mechanisms that are out there. So the pros and cons of royalty and streaming. We could spend an hour talking about that. You need to understand, obviously, when the ducks are quacking, you want to be hitting the bid. It's about being realistic with your expenditure, understanding how do you take your project to the next level, how much will it cost, what is the likely response going to be in the market, i.e. if you're drilling and the market doesn't care, you're getting no positive share price response, it's arguably irrational to keep doing something if there isn't a positive impact. And so it's also being willing to walk away from a project too. I mean, we often see, particularly with earlier stage things, if you have a single asset company with one project and it's a dud, they just keep going at it, and that's a poor use, it's a poor allocation of capital and ultimately value destructive. And so you want a sense from management that they understand the business side of the business and can execute. And the thing that I look for is, does management do what they say they're going to do? This isn't rocket science. And this is my other pet phrase, is trust is absolutely the rarest commodity in our business. And so if you can engender trust, and very few companies can do it, but if you engender trust with the investing community, you will have support all day long. And you see that reflected in your share price. And obviously, if you're trading at a high valuation, it gives you an enormous amount of flexibility with how to conduct your business, whether that's raising equity or it's doing an M&A transaction, whatever the case may be. But management is paramount. And so you need to understand the technical side of the business. You need to understand the capital market side of the business. You need to understand the promotional side of the business. And you need to understand where you are in the cycle. Because obviously where you are in the cycle should be dictating certain types of behaviors.
Yeah. Okay. So I wanted to jump into that. Now, a lot of what you shared, it resonates with me. I need to be conscious that I spend a larger amount of time in this industry than probably most of my viewers do. And so I guess where that leads me is I agree with you. Management needs to be conscious of the cost of capital, conscious of dilution, all of these things. As a retail investor, though, what can people do to protect themselves from bad management, making bad decisions? And I gravitate towards track record. Mark O'Day, you mentioned Mark O'Day, and he's somebody that I'll back all day long. He's been on my show a handful of times. My audience got to watch him in 2020 walk Pure Gold right up to production. He came on 3 or 4 times during that process. And exactly what you said. I said, you guys met Mark. He told you what he was going to do, brought him back 2 months later, right? He said he was going to do A, B, and C. Well, A is done. B is underway. C is getting started. He did exactly what he said he was going to do. This is what we look for. And when I have CEOs on the show, that's the game plan. It's like, let's check in with you. Tell us what you're going to do. Let's bring you back 2 months later and see if you did it. And then we can make our decision.
I think that's a great way to look at it. And obviously not everybody, you have to have a first-time management team and a first-time CEO that may not have a track record. So it's much, much easier to decipher management success if they do have a track record, but let's just set that aside because not everybody does. So the things that I'd be looking for with a new team is, do they have a board? I look at the peripherals. Have they been managed to attract a board that seems to know what they're doing? So if I was a freshly minted CEO, I'd be looking for a board that has the strengths that I don't have. So in capital markets, that have had successes before, that understand how the business is run. So I think we have to be cautious because I think our industry is somewhat guilty of recycling mediocre CEOs simply because they've got CEO experience. And so I think as I look around, I think there's a lot of embedded frustration. And I spent 18 months trying to get a gold asset out of a mid-tier company, an asset in Brazil, and I was gazumped at the last minute. But during that exercise, as disappointing and frustrating as it was to lose out when I'd spent a significant amount of my own money, was I realized there's this pool of talented people out there that at this perfect age group, kind of mid-40s to mid-50s, that are bumping up against the glass ceiling of this entrenched layers of management and who are ethically very good, have very strong technical skills. And what they want is they want to be involved in successes and delivering value. And so it's that people that you want to, this hunger to be able to shine. There's a lot of people out there that aren't getting a look in. So when people say that there's a real people problem in our business, there isn't a people problem. What there is there's a lack of leaders that these people want to work with or work for. So I gave me, I suppose, a lot of, maybe faith's the right word, a lot of confidence that there's a bunch of people out there that if they get an opportunity will do very, very, very well. And so I would like to start seeing some of the emergence of the new leaders, like the names that are less well known in our sector.
And I wonder if that's avoidable or if it's unavoidable because, you look at, it's a challenging business, right? To determine what's under the surface of the ground before you go looking for it. And yes, there's a lot of leaders that probably shouldn't be followed in this business, that run companies that probably shouldn't be financed in this business. And I wonder, is that necessary though? I mean, in order for the I don't know. I don't think so. I talk myself out of it.
No, look, it's not necessary, but you can understand why it occurs because you have boards that are, okay, this is what I think the fundamental problem is. I don't think companies understand enough what investors want. I think there is not enough communication. And part of that is a lot of investors don't want to seem to be activists. They want to ensure that they remain in the news flow. And so sometimes they're not frank enough about what it is that they want to see from management teams and boards. So you have boards acting, I would say most boards are trying to do the right thing, but they're doing that right thing in isolation. And most directors that sit on boards, they don't come from an investing background. They come from working for corporations, and occasionally you see an investment banker. And so I think there's a disconnect in understanding at the end of the day, An investor wants to see the share price go up, and they want to see alignment between management and the board, and they want to see sensible capital allocation decisions, and they want to see positive performance and delivering of those key elements that make a business successful over the long term. That's all they want. And they don't care who does it. They don't care if that person has been a CEO before or who hasn't. They just care that there's good people. And so I think you have this kind of this disconnect between, and boards are going, hang on a minute, we need a new CEO. We want a CEO who's been a CEO before. Even if that CEO was an abject failure and everybody hates them, all the investors hate them, the board may not know that. So for me, there needs to be more communication between the two groups.
I like that. So I want to pull on something else here, because you talked about the importance of looking through the team, looking through the board, looking through the executive team and saying, who on here has a track record? Because it could be a CEO without a track record, but for some reason you look at the board and there's a suite of legends on that board. Yeah. So, okay, what do they know that I don't, right? And as a retail investor, that's really important. That's the diligence you can do. You can look at the whole executive team, the advisory board, the directors, and say, okay, I don't know who the CEO is. I don't, but I can identify through just some quick diligence. It's easy to do. Google names. You can find out who's got some great exits behind them, who's put projects into production, all this stuff. And that can give you the hint to say, well, they've been in the business longer than I have. They dedicate 70 hours a week to this, and they are confident in this person at the top and the project that they're tackling. Now, where that can get confusing, though, is an endorsement by a paid guru. And that's not the same thing, but it's super prevalent, right? And so you could say, oh, but this personality with so many followers and they've been in the game so long and look at all their, they love the project. So maybe I should love it too, because that newsletter writer loves it. So that's an important distinction to draw, though, right? And maybe you can get back to like skin in the game versus pay to play. But what do you have to say about that, Nikki?
I think you understand, again, you need to understand incentives. So if it's a guru that is upselling the story or promoting it, are they doing it because they own equity in that company and they're really invested in the share price doing well? Are they doing it because they're getting paid to do it? Are they doing it because they had really, really cheap stock, and that stock that the average investor, doesn't have? I think there's some absolutely fantastic, incredibly well-respected pundits in our sector that are they're as honest and ethical as the day is long. And then there's also the complete opposite. And so I think it's do your due diligence. If it's a pumper and dumper, and they're recommending a stock, I'd be a little bit concerned. But having said that, the advantage that a retail investor has over institutions, which with this junior sector, they're stuck. My ex-boss said getting out of many juniors is like a bad divorce. It takes you 5 years and you lose 80% of your net worth. So, but as a junior, you can trade. And I don't do this. It's not something I'm in favor of, but that there's certain names, if they get behind a story, that there'll be a significant uptick in the share price. And you can trade that as a retail investor. But I think you need to understand why a share price is moving. Obviously, you want it to be moving because of the fundamentals of the business, not because some paid promoter is upselling it. Because normally what you see is this big tick up and then a pretty dramatic big tick down when they stop pumping the stock.
Okay, so that brings me to, I think, an important rule that you have. You should write down the reason that you buy a stock, right? So that the reason that you would sell it. The reason that came to mind is because if you purchased a stock because you felt like it was about to get hyped, right? Just be really clear on that. And I caution people away from that, because I don't think that you can out trade the market, right? You can get lucky and it's easy to get excited and, but if you look at the most successful investors in any sector, they're investors, right? They're not traders. That's what you see.
I agree. I also think, though, so if you're taking a view on the commodity, so I think there's different kinds of stories for different times where we are in the cycle. And there's an incredible predictability to our cycle on the up and down swings. And we always think it's going to be different, and it's never different. And so understanding that the broader cycle gives you enormous power, I think, in terms of how you invest. So we know that optionality in a crazy bull market, big ounces in the ground stories that that more than likely never have a chance in hell of being developed, they'll do incredibly well for a period of time. And so I think it's also going, this is the kind of story that will do well in this part of the market. and I'm happy to own that for a certain amount of time, but I also need to know what my exit is. And then there's those stories that are the slow burns that might be they're doing some interesting work, they're doing sensible exploration, you think there's a decent chance of them hitting a positive drill hole that you might be wanting to get in at a certain point in time. And we know the sweet spot in our sector is it's the sexy side of the business, like Great Bear, going out, a bit of a topical one, and they don't have a resource yet, and a $1.8 billion acquisition. And so this is when there's no truth meter that's in the company yet. And so, we normally resources disappoint, although Chalice has proven us very, very wrong. It continues to do very, very well. Economic studies is normally the trigger when you have this first big disappointment. So it's always you go, well, I'm going to lighten up before they release their first pre-feasibility study, for example.
Yes. Okay. So let's talk about that selling strategy. It's something that you speak a lot about, and it's important because it's the more difficult, less exciting part of the trade. It's exciting to buy something. It's exciting to make that purchase and pull the trigger, right?
It is.
And getting out of a trade is much more challenging in my experience, right? On either end, whether you're up or you're down, it's a lot harder to determine when to hit that bid. And so what can you share about how you approach that?
Yeah. And I talked about this in a recent presentation, and what I'll say is everybody struggles with selling. We saw very famous portfolio managers in the precious metals space not only perform in line with the GDX and the GDXJ, which were down 76 and 80% respectively from the peak in 2011 to the nadir of the bear market in 2015. So if experts in our sector can do this, I think you have to be aware that don't be too hard on yourself if you screw up the selling side of the equation, because we all have. And if someone tells you they haven't, they're lying. So at the end of the day, you have to sell. You don't realize an investment until you sell. And sometimes I think we mistake a bull market with brains. So be aware of that. To your point, you're not as smart as the market. And again, I think if you have the discipline to write down why you buy something, and then you circle back to that on a regular basis to go, okay, is my investment thesis intact? Has it met my triggers? If it has, do I need to revisit it? Do I need to sell? Should I be buying more? It's actually, you have to do the work, and then you have to make a decision. And in my experience, our species is loath to make decisions when we have a lot of choice, and we're particularly loath to make decisions when there's risk. And so that's why we seem to be very, very bad at selling losers. And to your point about the best investors being investors, not traders, I think the investors that show the best returns over the long term, they sell their losers the earliest. So you have to have the imagination. If you're down 50%, that it can go down another 90%. And that's happened to me. So in fact, I had one that went to zero. So I went bankrupt. So I just think you at the end of the day, you have to sell. So you should always be looking at your portfolio, your individual portfolio, and making a decision essentially every week. Do I continue to own it, or do I sell it?
No.
Or do I buy more?
Or do I buy more? Yeah, exactly. It's hard to give up on your conviction, right? Sometimes if you're sitting on a story that was, for example, there's a handful in the market right now that financed in the summertime, and there was still quite a lot of demand for some hot stories, maybe in the spring and summer. One, I won't mention their name, but I remember this story was raising cash at $1, and it was like people were selling their kids to get a piece of it. You couldn't get in the financing, and it's trading at 30 cents today. And so, put yourself in the mind of those investors. What are the obstacles that we often fail at overcoming when we need to just cut our losses and move on? Is it greed, or, loss aversion is a huge one, right? It's really important. Loss aversion and greed is what we do. Is if it's down 20%, we have this irrational thesis that, it's at least going to get back to where I bought it. Yeah. And so again, kind of it's human beings, we're emotional species. Let's not pretend that we aren't. Otherwise, we're sociopaths or psychopaths. So you need to step back and going, would I buy this today?
knowing what I know, would I buy this today? And to your point about this correction that we've seen in the gold sector, normally at the end of the year, it's always a good time to be buying because we're in this selling tax loss season. We had a lot of enthusiasm at the start of the year. And so there's some companies out there that are massive buying opportunities because they're cashed up. Nothing in the business is broken. The business is intact. Obviously, you have to take a view on the underlying commodity price. So for example, if you think gold's going to $1,000, you sell every single gold stock that you own. So it's about stepping, and it's way more, it's a lot easier to be objective about things, obviously, that you don't own. But I think it's constantly going, and it's okay to make a mistake, to say to yourself, I screwed up. I made a mistake. I need to cut my losses and sell, or else go, look, I think that longer term, maybe this is a okay investment opportunity, but I think my money be better positioned somewhere else. And having tax losses in Canada and in America and Australia and the UK, tax losses can be offset against gains. So cementing a loss is not necessarily the worst thing to do if you have gains to offset those as well. So you have to be aware of your own inherent biases. I think you need to be constantly trying to bring objectivity into your assessment, and also speaking to people that you know that might be experts or might know the company. Look at interviews with management teams. The great thing that we've seen over the last 2 years is this incredible proliferation in accessibility, I think, with all these virtual conferences and discussions that have been going on. So the average person has access to this huge amount of information that they probably didn't have even 2 years ago. So there's a lot of resources out there. And again, I just think to become a better investor, you have to do the work. And if you're not willing to do the work, this is a really high risk, volatile sector. Don't invest in it.
Yeah, or any sector, maybe. I mean,
yeah, exactly. Sector.
It's really important, right? To when you say do the work, right away, I gravitate towards. To me, investing. It's like my fitness routine, right? Like you don't get fit. You can go real hard for a month, but if you quit, like you don't carry those results, right? You go right back to square zero. And investing you need to determine how much time you have to invest in being an investor, because that's what's sustainable, right? And if you have 2 hours a week, you have 2 hours a week, nothing wrong with that, right? But that will dictate how much exposure, what kind of investor you might want to be.
Exactly. No, it's how you have to think about it. And the problem is we always hear the get rich quick stories. We always hear people's successes because, again, we never talk about our losers. And I think our sector would benefit from people talking about where they screwed up, because in many ways you learn more lessons from those negative experiences than you do from the positive experiences. And also stocks can move for things that you had no idea that. But you might have your list of things that you thought were positive alpha events or events that would move the share price. And then none of those things happen and the share price moves for something completely different, like it might be contiguous with a company that has an asset that gets taken out. So there's always these other themes at play. And then some companies, their share price moves. It's a gift from God. It might be something that is unsustainable in the long term, but it's a positive event. You've got to be aware of not drinking the Kool-Aid. That's maybe what the best way to say it. Don't drink the Kool-Aid. Constantly be rigorous in your level of objectivity about your investments.
So looking at the market now, broad strokes, Nikki, where is Kool-Aid being poured? Where should we be a little bit skeptical about putting capital right now? Anything come to mind?
Oh, I think you have to be cautious of some of these drill plays that get excessive valuations. Okay. So, for example, we won't name names, but I'm sure you can guess. Like there's one in a certain part of Canada that has a huge amount of enthusiasm, has a valuation well in excess of $1 billion, unlikely to have a resource estimate based on management's presentation recently at the Precious Metal Summit conference in Beaver Creek. These things get frothy and get ahead of themselves. And circling back to Great Bear, I think Great Bear has done an absolutely superb job. Obviously, they've had a great discovery, but exiting when they have all the love and this frothiness about what it could be, we don't know what it is. And so again, we tend to, as humans, go when we don't know what the upside is, we assume it's limitless. So the risk, for example, with that transaction is on the buying side, not on the selling side.
100%. So yeah, smart sale, that's for sure.
Smart sale. I mean, I've heard some rhetoric that Great Bear shareholders are unhappy with the price, and that's a pretty good.
Take that and run. That's all I got to say.
Well, yeah. I did some work on it. It's actually fascinating because it started moving. It was moving lockstep and barrel because obviously some of that sexiness of the drill results, when you've been producing good drill results for in excess of 3 years, the marginal impact of another drill result, it doesn't really do anything to your share price. And then you start, investors want to see a resource. And then what happened when it started to move in contravention with the sector was when Barrick created the froth. I mean, they acquired the ground contiguous with Dixie. Everybody thought Barrick would take it out, and then Kinross stepped in. So after the share price had moved up essentially 100%.
Yeah, exactly. You know what I have to say about Great Bear is I've had Chris on the show a couple of times. I've dealt with his team extensively, and you know, what I can say about that company is they built an amazing culture. Every engagement I've had with somebody in the team, I've left feeling, really confident in their competency. It doesn't speak to the geology, but it speaks to their character and the culture they built in-house, which I was very impressed with. Yeah.
I think that feedback is pretty universal, and that says something about a company that they can in a sector where we're pretty easy and quick to criticize each other, that's a fairly uniform observation about how they've conducted themselves.
Interesting. Okay, so let's talk about the cycle then. We focused this conversation on the commodities sector. It's your background as a geologist. You've been through a few cycles, as have I. We got through a super hot 2020. It was like you couldn't do wrong, just darts at the junior mining sector, all shifts being risen in the tide, and 2021 punished a lot of people, right? I think it was. Now I look at that and I love it because I think that we had gotten. If I say we, what I mean is the commodity sector had gotten ahead of itself, right? There was a lot of there was financing on my desk 4 times a day. Yeah. They were raising the money they were asking for, and that's not really good for. It's not good. It's not good. Like we talked about earlier, there's a lot of CEOs that shouldn't get the money they raise, right? There's a lot of projects that shouldn't raise the money they raise, but they do, So what do you think about this cool off period, 2021? Good or bad?
Good. Needed to happen. I think anytime you see it go parabolic, and we saw that, remember in 2016, and that was partly because at the end of 2015, everybody was suicidal. And then at the beginning of 2016, you just saw this chart go like this. And I'd bought a whole bunch of stuff at the bottom of the market, and I was out of it, all of it, within 4 months, simply because you saw a chart like this. Yeah. In any bull market and bull markets can have and it's painful probably when you're in it, have a long duration. You need to have pullbacks. It's sensible. If it is like this and like this for too long, you end up with a terrible bear market. So I think it's healthy. It's sensible. I think that you have a number of companies that are probably in the best position that they've ever been in terms of their balance sheet. So as an investor, if you can invest in something that has a good management team that is cashed up, they're not going to have to hit the bid on the equity markets. They've got a sensible business program, and their share price is down a hell of a lot to what it was, but nothing is broken in the business. I'd buy those companies all day long. So I think we are in the cycle. Always December, end of December is a great time to be buying. We're seeing a whole bunch of companies being chucked out in terms of just everyone's throwing up their hands, tax loss season, selling, et cetera, et cetera. So, I'm actively, in fact, I'm leaving it for a few more days because I won't care just before Christmas as well. So I think it's healthy, it's needed, and it creates a buying opportunity. It's really hard to do. Everybody wants to buy when things are going up. And Buffett said it best, buy when everyone's fearful.
Do you think every industry is as temperamental as the junior mining industry? I mean, you referenced 2015 and you used the term suicidal to describe the sentiment in the industry. And I remember that so well because I joined this industry, being the junior mining sector. I started getting very involved in it in 2010. Okay. So that was at the tail end of a crazy frothy bull market. And it was a very loud, flamboyant industry at that point, right? Yeah. I honestly didn't enjoy it very much. And then 2011, the sky fell, right? And everything fell off a cliff. I remember conversations with, IR reps at the time in the business who were like, this may last 18 months. Get ready, 6 years later. So, but what an awesome opportunity for myself personally. I'm so grateful for that because, 2013, 14, 15, 16, anybody who stuck around, they meant business, and if you were still willing to put work in, you met amazing people. It allowed you to climb the ladder of intelligent professionals in this business so much more quickly than I imagine it would have been in 2009 and 2010, right? Hard to get the meeting you wanted, right?
Yeah, I actually think it's easier from personally speaking, it's easier to be buying in the bear market because. And I had the opportunity because I'd resigned from working for a fund. So obviously I was restricted. I couldn't trade in anything working for a precious metals fund, but I exited Sun Valley with this knowledge about the sector. And my take at the end of 2015 was I didn't predict 2016. Nobody did, in my opinion. It just was, the sentiment was so bad, it meant you were at or close to the bottom because literally people were exiting from the space. Gold is dead, never coming back, the same. And that's when people say that is when you should be buying. And so I think to me, that's way easier than what you saw in 2020. 2020 is really, the 2020s of this world were really, really tough because when it goes parabolic, you might be saying, well, it looks expensive in mid-year, and then it continued to go crazy into August, September of last year. And so, I've missed out. And that feeling of missing out, and then there's a greed driver at play, is when you see people starting to jump in, and then you see a correction, and everybody's saying, oh, it's dead. It's only lasted for a year. It's dead. So we're seeing this. If we look at the charts of 2015, we've been in an upwards trajectory, but we've had, which is actually absolutely classic, kind of these short-term runs, pullback, short-term runs, pullbacks. So it will always be like that. It will never be all the way up and it will never be all the way down. I do think that times like this, it's way easier to make that investment decision. It's just psychologically speaking, it's hard to be there in a wall of selling and maybe just acknowledge that if you're making a buy, if things are selling down, you're probably never going to bottom ticket. You have to be okay with it going down another 5-10%. But with the understanding expectation, and obviously it comes back to where you think commodity price is going. If you think gold is over, you wouldn't be investing in the sector. Yeah.
Well, I've heard that comment recently, actually on the heels of the September conferences in Colorado. People coming back and saying, if gold's not performing in this market, I think the story's over. What a time to be alive that we will end a 5,000-year cycle, Nikki. It's impressive.
I don't think gold will never be over. Gold has a utility and a use. I think what our sector and the leaders in our industry have done that's negative is we have seen this market share that's been taken away from gold into cryptocurrencies. And we have done an incredibly poor job of ensuring that gold should be appealing to a wider range of investors. So if I sit back and go, gold, I think is a sensible part as in terms of managing your risk of anybody's portfolio and gold equities. Obviously, I'm not an advocate that you own 100% of any single commodity or equity complex, but gold has a really important part to play. And the same thesis as to why you would invest in gold is why you would invest in cryptocurrencies. And so I think our sector, our industry, and the leaders in our industry need to take a long, hard look at themselves and asking themselves very tough questions, which is, how did this happen? And how do we kind of stop the bleed of people who would have a natural affinity for our sector going for what it's part of the sexiness of the technology industry and cryptocurrencies. And you want to talk about inflation. I mean, I keep seeing different numbers, but between 10,000 and 13,000 cryptocurrencies out there. So I think there's things that our industry can do that can appeal to the marginal investor, because the gold bugs are always there. The gold bugs in 2013 were saying, well, it can't possibly go lower. Gold's going to $3,000. So if you're a gold bug, you're always biased towards the upside, but it's a sensible investment for anybody that's concerned about risk. We live in this world of incredible risk right now, inflation. I think no matter what anybody says, every single person experiencing inflation of some sort, and probably not that positive in terms to their free cash flow in terms of their own lifestyle at the end of the day. So it's how do we message gold better? And I think it's easy to do. The trouble is you have a generation that doesn't understand how to speak to young people.
Yeah, and it gets me back to, well, gold's a boring investment by design, right? If it does what it's supposed to do, it's relatively boring. And that's what I like about it. And I acquire gold on a frequent basis. I hope that I never need it, right? It's one of those things I would love to pass to my kids one day, right?
Yeah.
And that's what generational wealth is. But it's a patient, long-term game. Back to investing is a lifestyle, not, something you just do for a month and then you're good. Right. And as part of your portfolio, I recommend people think about part of their portfolio as building that lifelong war chest. Right. Yeah. Whether that's, and so the thing is with gold is that it's the same with Bitcoin. There's this evangelical nature about a lot of the community that supports it, and so if you said it, I mean, gold bugs are going to be more biased to the upside. Well, so are Bitcoin evangelists. It's the same thing, right? Laser eyes, all this stuff. And as a generalist, or I don't know, as a sector agnostic investor, I'm turned off by both. And you guys are in love with your asset, and that's dangerous, right?
Yeah.
So just pump the brakes here, right? This isn't going to solve everything, but it's an important part of your portfolio, and you should acquire some over time, right? As part of your long-term strategy.
Yeah. And I think the fascinating thing that we're seeing play out, and I don't know how this ends, is, and retail investors are probably less focused on it, but it's going to influence share price performance. It's this whole ESG focus. And with the battery metals, obviously, it's an easier sell for ESG. I think still, the mining industry has done a very poor job of communicating to the average person just how important mining is. You can choose to be a vegan, for example, but you cannot choose to be not associated with a product of mining. And so many people don't understand where their stuff comes from. And mining is bad. You speak to the average person on the street in Vancouver and ask them what they think of mining. Their resounding response will be, it's awful, we should stop all mining. And you go, well, actually, you know what? We should do that for a week so the world understands just how critically important mining is. So gold will get a little bit more of a focus because of the utility of gold, as a bit like cryptos. Cryptos use a huge amount of energy, but on the positive side of gold mines, for example, there's a lot of job creation. There's the S and the G side of the ESG. There's a big benefit. Of course, it does have an impact, as every human activity does. So I think circling back again, we've got to be better about messaging on the gold side. And then we're calling doom and gloom, and we've got gold that it's in the 1700s. So, I mean, I remember when it was below 1100, and that was a bad time. So in some ways, you have gold companies that are the cheapest that ever producers. They're the cheapest that ever been. They've got the lowest price to earnings, price to cash flow multiples. If you want to look at a business that is financially incredibly healthy and undervalued versus other sectors, there's a real rational reason to be investing into a lot of these mining companies from a pure comparison on financial metrics, excluding what it is that they're invested in.
100%. Yeah. I mean, it's very tough right now to find anything that isn't inflated in price. This is the one sector, though, that is absolutely depressed and provides a lot of upside. Plus, a lot of shareholders are down 50, 70% on their money. And that's a positive sign if you're a buyer. But it, gets me back to are other industries as temperamental as this one? Because to your point, $1,700 gold is pretty good. But as soon as the money's not easy, people start beating their head against the wall saying, well, when's it going to turn around? Relax.
I know it. And I think that's part of it. And part of it is it's because people experience 2020, it's that same thing. Oh, well, it should always keep going up like that. And that's insanity.
Yeah.
It's not going to. So if you can't deal with the volatility, you shouldn't be invested in the sector.
I'm with you on that. Okay. Nikki, it's been great. I ran out of time. I realized I'm overtime when I told you I'd let you go. We ran over. But look, I appreciate it. So thanks so much. Are you going to come to my show in January? I've got a conference in Vancouver, mid-January. You should come.
Yeah.
Can you come?
Yeah, absolutely.
Okay, awesome. We'll send you all the details for it. It's going to be a lot of fun. Okay, look, thanks so much for coming on, getting in front of my audience and chatting with me. Nikki, it was an absolute pleasure. I learned a lot and had a lot of fun. So thank you.
Thank you very much as well. And I can't believe that an hour has already gone by. I thought it was basically 20 minutes. So that shows that you're having fun when time passes quickly.
I love it. All right. Thanks, Nikki.
Great. Thanks a lot, Jay.
Okay, guys, 3 last things. First, if you enjoy my interviews and would like a bit more, you can subscribe to my Friday newsletter. It's free, and the comment to subscribe is right beneath this video in that pinned comment. In this newsletter, I share my key lessons learned, takeaways, and any actions that I might be taking in the market as a consequence of what I've learned on the show. Second, when I started a YouTube channel, I never anticipated generating any advertising revenue. But coincidentally, I do now, which is awesome. And so what I've decided to do is donate this to an organization that is very close to my heart called Zero Ceiling. Their mission is to end youth homelessness. The way they do this is by providing young people experiencing homelessness with supportive housing, employment, professional support, life skills, and outdoor adventure. Because often young people in urban centers with no resources will never get the opportunity to experience wild places, nature that can be so transformational, and absolutely was for me. Third, if you prefer to listen to my content, you can now find us wherever you listen to podcasts. Just search for The Jay Martin Show.